What's up? What's up? How y'all doing? Hope y'all are doing well. We changed the hour of the backtesting session. Wait, let me just go here, so y'all could watch some football on Sundays. But yeah, so today I wanted to switch things up a little bit because I know, a lot of people may like the strategy that I show, and some people may not necessarily like it, or it's not necessarily their style of trading, and they prefer to trade higher risk to rewards, or make some more higher time frame analysis. So I will definitely show you guys a way that I am reading the higher time frame in order to find the direction. And it's not necessarily going to be, I'm going to show you guys basically the scalps you could have caught this week at first, but then I'll show you guys a little bit more advanced concepts on ICT, and I hopefully you guys will enjoy. New camera angle. I think it's the same, no? Should be the same. But yeah, so first thing I'm gonna do is we're just gonna go over the best trades you could have caught last week. We're gonna go over that pretty fast, and if we get enough likes, we'll do two 50k growth giveaways. And I know we're not gonna be a lot today because it's 5 p.m. and a lot of my people are watching from Europe and Asia, so smash that like button for sure. And if we get to 50 likes, we'll do the first 50k growth, and if we get to 100 likes, we'll do the second 50k growth. So two 50k growths to give away today. All right, guys, so first thing I'm gonna do is we're gonna go over all the trades you could have caught last week using the scalp model that I show, and right after that we're gonna go over a little bit more backtesting with a strategy that I really like to find my bias on the higher time frame. And that's one thing also that I like about backtesting, is that you don't necessarily need to backtest entries or stop loss placement, risk to reward. You can just go, let's say, on the higher time frame and be able to and try to predict where the higher time frame candle is going to expand, and this gives you a really good perspective on how to read the chart and actually what are the market mechanics. Okay, you should be backtesting. Yeah, for sure. I'll be backtesting on FX Replay. The tournament is done on FX Replay, guys, by the way. We're gonna do trade wars if you guys want, and these are on FX Replay for sure. And yeah, we had some few updates on Tradeify. I'm gonna talk a little bit about this later, but for now, let's start with last week's best trades. So we're gonna go here on Tuesday. I'm gonna go fast because I want to backtest a little bit more with y'all today. So the first trade was right here. So basically, always what we're looking for is this to happen in the market. We want to see a fair value gap being formed on the higher time frame. What is a fair value gap? It's a 3 candle pattern right here where the up wick, okay, so let's say it's a bullish fair value gap, okay, let me mark out those wicks here, okay, of those candles. So you see those candles have wicks. So the wick, the up wick of the first candle doesn't tap into the down wick of the third candle, which lets an imbalance right here. Okay, this imbalance tells you a lot about what price is most likely gonna do, because it tells you, all right, a lot of aggressive buyers are located right here. So it gives you a key level that can act as support for basically price to bounce from in order to create new highs. What do? In this case, you don't necessarily want to enter aggressively right here predicting. There is always one strategy behind it, and it's to look for those fair value gaps in the chart and wait for aggression from opposite participants when you enter into this gap. And when you have a lower time frame sellers that are trying to push price down inside a higher time frame bullish zone, what is most likely going to happen? One of those participants in the market is going to get squeezed. So then you never want to fade the higher time frame buyers. Here in this case, you never want to fade the bias from the fair value gap here on this 15-minute chart. So you would look at this 15-minute chart to tell you, okay, overall we're bullish, we're creating signs of aggression from buyers, and then you would look to see those sellers being squeezed here on the lower time frame, so you can take an opportunity back towards the most recent high. So this is basically what I'm going to be looking for the weekly recap, and then we're going to go over and talk about a few other things today. So here we go. The first trade you could have caught was here. Let's write down this low, which is the previous daily low. Not necessarily the previous daily, but this is a daily low, which is a huge area of potential support. So then once I mark out this low, I can also see that we have a lot of displacement. I can also display, which means that we're creating bearish fair value gaps. If we're creating bearish fair value gaps, it means that there was not a fair transaction between buyers and sellers in this exact area. Okay, which means that price is not necessarily at its fair value right now. It's basically too aggressive to the downside. So we need a healthy pullback pretty soon in the market. So what is my key level that I'm going to use in order to target this 15-minute fair value gap? I'm going to use this previous daily low. So I'm going to look for the same exact thing. So now let me go over to this 3-minute chart. I know I have an unfilled gap above me, which should act as my draw on liquidity. So basically the area I want to target. So right here, after we sweep the previous daily low, which is my support level, I can see that we are forming a 3-minute bearish fair value gap. What does that mean? It means that on the lower time frames, the sellers are the one being aggressive in the market, but on the higher time frame, I can see that I have a daily level where we could definitely bounce from. Okay, so there is an area right now on the chart that there will be a fight between buyers and sellers, and I know that if I have confirmations of a key level being bullish and a lower time frame confirmation of those sellers being squeezed, I know I have a really good long opportunity towards this unfilled gap. So here we sweep previous daily low, sweep the sell side right here, can't close a singular handle below it, then we push up, we disrespect this bearish fair value gap. If we were truly bullish here, we should have respected this gap in order to create new lows, but in this case we disrespected it. So this is exactly where I would go long and stop loss right below this candle's low. Okay, so the first trade would have been here, stop loss. You can put your stop loss at the bodies, and then right here aim for a 1-to-1 back towards the unfilled gap. So here in this case, 6 minutes and you hit your target. Okay, so what can I see from this trade? What was it so good? We had a previous daily low sweep, so we were bullish. We had a perfect sweep. Basically, we can't close a singular handle below the low. We have an unfilled 15-minute bearish fair value gap, which told us that, okay, price was not was going down so aggressively that we need to retrace back here to see price being at its fair value, basically. And right here, we also have a bearish fair value gap, so signs of aggression from opposite participants in a higher time frame bullish zone. So then we disrespect it, and you have all the confirmations in the world to go long for a quick scalp. Okay, these kind of plays basically are quick scalps in the market. They're not basically ways to predict a whole daily expansion or distribution. This is just quick scalping, looking at key levels and order flow confirmations on those lower time frames. Okay, so right here, this was the first trade you could have caught, which was on Tuesday, and on Tuesday there was no other good trades you could have caught. Okay, then let's go to Wednesday. Wednesday there was two trades, one being a loss, one being There was multiple trades, but one of them was being a loss. And right here, as you guys see, we have this buy side liquidity, which acts as our area of resistance, also with this 15-minute bearish for value gap. Okay, so I know that if I have lower time frame confirmations that buyers entered aggressively inside this higher time frame bearish zone, and I can create a 1, 2, 3, or 5-minute bullish for value gap. If we're truly bullish, we should hold this zone in order to create a new high. But if we're bearish though, and the sellers are strong enough, we will disrespect this gap, and this will be our confirmation to go short back down towards the most recent lows. So here in this case, we had exactly this happening on the 5-minute chart. Unfortunately, it ended up not working out in our favor. So here, the short in play was back to this inverse stop loss right above this candle's high, and aiming for a 1-to-1 risk to reward back down towards those equal lows. Here you would have gotten squeezed, but there was another opportunity to take right after that, which was exactly the same exact framework but on a different time frame. So one thing you could say to yourself is the 5-minute chart is a high, it's quite a high time frame. So the best time frames to look for basically are the 1, 2, and 3. Okay, so here in this case we swept buy side again towards our key level, and then we create a bullish for value gap. As you guys can see, if we're truly bullish, we should respect this lower time frame zone to create new highs. But if we're bearish though, we will disrespect this gap and we will go towards the most recent low for 1-to-1. So here, exactly here, this is where you disrespect the gap. You don't want to engage here because you're going to have a bad risk to reward. Usually price comes back towards those inversion here. Why? Because those buyers would need to cover, so they would need to click on sell to get out of the position. So everyone will be selling at the same time, which will create a lot of aggression from the sellers here. So here in this case, the play was to wait for the pullback and then right here take out your profits for a 1-to-1. So this was the second play you could have got, basically second winner you could have caught on this week using the strategy. So now let me go over another trade you could have caught using the same exact system. So now, as you guys see, price is going down aggressively, creating bearish for value gaps on the higher time frame. What does that mean? Sellers are the one controlling the market, and we're going down aggressively. So what do I want to see? I want to see signs of aggression when we enter inside this 15-minute bullish zone by creating a 1, 2, 3, or 5-minute bullish gap. And if we can disrespect it, I'll go short back down. Okay, so here it was on the 2, so I can mark out this level, and let me wait for signs of aggression from those buyers when we enter inside the zone. This is exactly what I got. Right here we formed a bullish 2-minute gap. If we're truly bullish, we should respect this bullish for value gap here on the 2-minute in order to create a new high. But if we're bearish though, we will disrespect it and we will create new lows. Okay, so here you wait for this for value gap to get disrespected, exactly here, stop loss right above this candle's high, and you aim for a 1-to-1 risk to reward back down. Let me just change the style here. Pulls back down, and right here would have been, so pull back towards this inverse short, and then 1-to-1 risk to reward back down towards the most recent low. Okay, sell side liquidity. So this is basically the strategy that I'm always showing, and trying to look for the best scalps of the week, low risk to reward scalps of the week. I truly think that one big mistake that a lot of traders are doing in the beginning of their trading journeys is to look for those higher time, like those high risk to reward plays, when in reality it requires so much knowledge in order to know when to hold your trades and when to stay out of the market. So the best thing you can do is getting those consistent base hits, and then have a strategy that doesn't happen quite often, but gives you an A+ setup to risk to aim for that high risk to reward. Okay, in order for a high risk to reward to trade to play out consistently, a lot of things need to align together. Okay, this is not a, let's say, cash flow play like this one. It is more, all the stars needs to align together in order for you to aim for 1 to 3, 1 to 4, 1 to 5. And in my opinion, those kind of opportunities are not necessarily happening every single day. They're happening 5, 7, 8 times in a month. So this is the difference between, understanding how to scalp and understanding day trades. And this is also one thing I'm going to talk about today. when are the stars aligning together? When can you take a trade that you're truly confident in holding back towards, let's say, the whole daily range? Okay, this is what I want to show you guys right after I go and take a look at the best scalps of the week. And really good question you asked, Marbara. Amos, do you strictly stick to a one-to-one risk to reward? Usually I do only stick to a one-to-one risk to reward most of the time. And truly the reason behind it is, yes, it is those kind of systems, let's say those lower risk to reward systems, are systems where you need a lot of money in order to make them work. Okay, because your risk to reward is low. But the thing is, a low risk to reward is basically gonna let you have a really clean equity curve. Okay, those loss streaks will not be as big as when you have a high risk to reward. So in terms of psychology, it's way easier to handle a low risk to reward strategy for me, okay, as a person, for me, than a high risk to reward, because high risk to reward mechanical strategies are extremely hard to make them work long term, because the market conditions are changing. Sometimes the market will be straight up pumping aggressively, and sometimes the market will be in huge consolidation periods. And what does that mean? It means that if you're swinging for 1 to 5 and whole daily ranges in those times right here, you're gonna start thinking that you're not a good trader, when in reality the market conditions are just different. Okay, but one thing that I like about one-to-one risk to reward though, and lower risk to reward scalps, is that I can be consistent in those market conditions where it consolidate, and also in those market conditions where it's trendy. Okay, so of course I don't think one-to-one risk to reward is the only thing you should be doing, let's say, in terms of a trader. I think you should know how to scalp one-to-one risk to rewards, because those are quick scalps and base hits you can build cash flow with. But in terms of the best plays and the plays that are going to make you the most amount of money, there are definitely those plays where all the stars are aligning together, and on the higher time frame and the lower time frame is telling you exactly the same thing, and the entry is perfect and the narrative is also perfect. So this, in my opinion, you need to know how to scalp, and you need to have also a strategy that will let you take those kind of plays 4 to 5 times in a month, that will open up more doors for you. What is your bias when the market opens? I will tell you all this after I go through this this market recap. So this was the 4th trade you could have caught. Then let's go on Thursday. So now I'm just showing y'all few scalps you could have caught using the same exact system. This is the most important thing in my opinion in trading, is to have the same exact system every single day when you come in the market. Okay, it's really important. Don't start switching your strategy because you are on a 3 trade losing streak. It doesn't mean anything. All right, you can definitely bounce back from that. Just trust your system. So right here, there was a really good trade you could have caught, in my opinion. And let's talk about this one. In terms of scalps, you had this low being the Asian low, okay, which is a time-based liquidity which acts as support, which is really good. And then you have a 15-minute bullish for value gap. So this zone right here is a zone where you don't necessarily want to engage in longs blindly. You want to mark out this key level and see, okay, what is the reaction once we enter here? Am I seeing aggression from the buyers? Am I seeing aggression from the sellers? Can I read what's happening on the lower time frame right here in order for me to know basically my odds of seeing a lower time frame retracement or price going back towards, let's say, the most recent high? So here we're entering inside this 15-minute zone, so bullish for value gap and Asian low. So then I will scale down to this 2-minute chart and find my entry model. What is my entry model? It is, I want to find signs of aggression from opposite participants when I'm in a higher time frame bullish zone. So what does that mean? This is a bullish zone. I know I have a 15-minute bullish gap and my Asian low. So I want to find signs of aggression from sellers that is telling me, all right, sellers are right here on the lower time frames. They're exactly inside this 2-minute gap. And we are entering a higher time frame bullish zone by creating lower time frame aggression. So you know there's going to be blood in the market, and when there's going to be blood in the market, there's always a good trade to take. So here I can say to myself, all right, we're on a bullish I'm on a bullish key level right here, and I expect that if buyers are standing up here, I will see some upside. Good. So then those lower time frame sellers, where can you locate them? Inside a 2-minute fair value gap, 2-minute bearish fair value gap, 1, 2, 3, or 5. But in this case, it was a 2. So here you can say to yourself, all right, if we are truly bearish, we should respect this 2-minute gap in order to create new lows. But if we're bullish though, and my key level was right, the buyers will stand up, will disrespect the area where sellers created that down move into my bullish zone, and we will see the most recent highs for 1-to-1. Okay, this is a quick cash flow scalp that I saw right here. So as you guys see, we disrespected that 2-minute gap. And one thing also about knowing how good your strategy is, or how if your parameters basically that you're using for your strategy are accurate, is the time that it's gonna take in order for you to hit your take profit or for you to get stopped out. If you have a certain narrative in terms of scalping, you don't want to see price chopping a lot and then going one handle away from your take profit and then going up. That means that you don't necessarily look at the chart the right way. Here in this case, look at how much time it's going to take for you to hit your target. 2 minutes, and then 4 minutes you hit your target, and it runs higher. What does that mean? It means that your way to read the chart is pretty accurate because you understand the concept of order flow. Basically, you understand the concept of, okay, my buyers are right here, my sellers are located inside this lower time frame 2-minute bearish fair value gap, and basically you're understanding the concept of squeeze. Okay, what is a squeeze? It's when basically not a squeeze, a cover. What is a cover? Let's talk about the cover, because I really like to use the market auction theory in order to explain what is currently happening on the lower time frames. Okay, and this is a completely different view than a lot of people, but for me, quick scalping is way better. But let's say here, what is happening? What is the concept of cover? It's when a market participant is forced to get out of their position either at a loss or at break even. So if you can know where they are located, then you know most likely where they initiated that move. So you know where they're possibly going to put their stop loss at, basically. So let's say here in this down move, you had this down move and you had this 2-minute bearish fair value gap. So you knew sellers were here. Good. But what does that mean? It means that sellers are located inside this 2-minute fair value gap. Okay, so they are initiating a down move. So here, if price goes up aggressively through the level where the sellers are, and they were selling here, and right now price is above where they initially started to sell, what is going to happen? They will basically be interested in getting out of their position. How so? They will basically manipulate price down towards where they initially started that move, and when price is going to come back towards their break-even spot, what are they going to click on? If they sold in the first place but they want to get out of their position, they will need to click on buy. So now this is a really good confirmation, because you know that once you see this, everyone will be clicking on buy at the same time. Buyers, aggressive buyers, responsive buyers inside your higher time frame key level will be clicking on buy. Those aggressive buyers are going to click on buy. Those sellers, even the sellers, okay, are going to be forced to click on buy, because the ones that initiated that down move right here aggressively are being squeezed. So then this is the concept of cover, and this is why let's say those gaps are so accurate, because they give you the lower time frame order flow of what's actually going on. Okay, you don't necessarily need to look at a footprint chart on NQ. On ESCS, well, let's say on NQ, those gaps are good enough. So here, this is the concept of cover. So every market participant is going to click on the same thing at the same time. So this is why the moves are really sharp, and this is why it doesn't take a lot of time for you to hit your take profit. Okay, one concept that is really good in scalping, you want to be right quick and you want to be wrong quick. Okay, so yeah, so that is basically the second trade you could have caught no, the first trade you could have caught on Thursday, and the fifth trade you could have caught overall. And you will see every time I will show you guys a trade, it will have the same exact framework, same exact entry model, same exact thought process behind why it is a good trade. Okay, and this is the most important thing, is to be able to take trades that are replicable in the long run. Okay, so let's say right here, what do you have? You have a 15-minute fair value gap right here. Can mark that out, but it was being respected multiple times. And you have this buy side liquidity pool right here. Okay, so then once you sweep this buy side, what is happening? All right, my trading view is bugged. All right, so same thing is happening right here. So we are on a higher time frame, bearish key level, sorry. So we know that responsive sellers are going to be interested here. We know that when we enter my zone, I want to see those sellers being aggressive, and I want to see them squeezing those buyers. I don't want to short, let's say, blindly here, predicting that they're going to step in above this high. This is predicting. You want to react to what is happening inside your key level and find signs of weakness at those highs and signs of aggression from those sellers. Okay, so let's say right here you had your higher time frame zone, here buy side liquidity. Okay, so just normal support and resistance, these are highs, and then you have your 15-minute bearish fair value gap. So now we are entering a higher time frame bearish zone. Good. What do I want to see? I want to see signs of aggression from opposite participants. I want to see those buyers being heavy when we enter this bearish zone. Why? Because it will tell me where they are located on the lower time frame, so I can tell myself, all right, if we're truly bullish, we should hold this zone in order to create new highs. But if we're bearish though, we will see a squeeze and a cover from those buyers, and everyone will be clicking on sell at the same time, so price will most likely go down aggressively. This is exactly what I want to see. So here I have a 1 minute bullish fair value gap. What is this? It's telling me that the buyers are located right here. So now I will wait. I will not want to fade. I don't want to fade basically my higher time frame key level. I want to trade with it. So now I'm waiting for this bullish fair value gap to get disrespected so I can short it. Right here, this is my confirmation. They're so aggressive that I can now short. So here, it's up to you. Here in this case, I would wait for a potential pullback to the upside and go for a 1-to-1 risk reward back down, because I know those aggressive sellers just stepped in, and if I can start trading with them, we will have most likely a sharp move back to the downside. I can't know if this is going to bring me all the way down towards those lows. This is the mistake that a lot of people are doing. Why are you trying to aim, let's say, for resting opposite sell side liquidity when you don't necessarily have a reason on why price should go there? Okay, this is also what I'm going to talk about a little bit later today when we're going to back this. But those kind of scalps, if you're not getting out in and out super fast of the market, they're not worth it, because they're just order flow scalps. They're just lower time frame scalp volatility models. Okay, they're not a model that you're like, okay, it's not let's say a power of 3 model, or you're not analyzing the daily chart. Okay, you don't know where price is going to go, but you know that on the lower time frames you have a whole lot of chance of seeing some downside right now. This is the most important thing. So now you wait for price to pull back towards your entry, and look at what price is going to do. Cover 1 minute, you hit your target. This is a good trade. Why? Everything was aligning together. Okay, we had our key level, so buy side liquidity sweep, we're bearish. 15-minute bearish fair value gap, we're bearish. We're creating a bullish 1 minute fair value gap. If we're truly bullish, we should hold it in order to create new highs. But here we disrespect it, we're bearish again. Then we see a pullback and we have resting liquidity below us, and then we short and it hits in literally 1 minute after we enter. That tells me that I was able to read accurately the 1 minute chart, knowing where my buyers were located, and as soon as we started trading below them, then they were forced to get out of the position, so they needed to click on sell. So everyone was clicking on sell at the same exact time, which made it a good trade. Okay, So those kind of scalps, they're not necessarily the type of way you've been taught to trade. Of course, it's a different framework. It's a different way to take 10 to 15 handles, let's say, every single day. Okay, now let me go over the last trade you could have caught this week using the same exact system. And of course, there will be losers, there will be winners, but one thing that is important when you have a strategy is make sure you're doing all the work possible to validate that the strategy is actually really good. Once you know it's good, then cut out all the noise and stick to your own path. All right, so right here the trade was exactly there. So you can see we're creating a 15-minute bullish value gap. What is this value gap telling me? Higher time frame buyers are the one controlling the market. They're right here. So now once price comes down to this level, I will monitor longs. I will look for signs of aggression from those sellers, and I will look for signs of aggression from those buyers also, so I can see a potential squeeze happening in the market. Good. So now I know this. I will scale down to this 3-minute chart because this is where the trade occurred. Let's wait for price to enter aggressively inside the zone. Wait, I'm actually dumb. I marked out the fair value gap wrong, sorry. So there was a gap here, but there was also a gap here. So you would basically try to go long from the first gap we react to. Okay, so here 3-minute, as you guys see, we react here to the gap aggressively. So now we enter into a higher time frame bullish zone by creating bearish aggression. Good. There will be one of those market participants that will get squeezed. I will not try to short that. I know that my higher time frame buyers are located right here. I will want to see those sellers being squeezed. So now I can tell myself, if we're truly bearish, we should hold this in order to create new lows. If we're bullish though, we will disrespect it and I go long. Okay, pretty simple. So here you see price pushing up. What do you want to do? You don't want to chase it. You want to look for price to pull back because a cover is going to happen. So right here, if I can really explain what is going on the lower time frame order flow, is that sellers initiated that down move right here. Okay, they're located right here. And now price is trading up there. What does that mean? Those sellers will most likely manipulate price down towards the area where they initially started that down move, so they can click on buy to get out at break even, and then the buyers, aggressive buyers located inside the 15-minute fair value gap, are going to click on buy, but even the sellers right here are going to click on buy, so everyone will cover and everyone will click on buy at the same time. So here in this case, let's take a look at what's going to happen. You will see price coming back towards those areas, which is extremely good to see. So you see price comes back towards this 3-minute fair value gap, and you see a wick. What is the next candle going to do? Pushes up. So you hit your target again in only 6 minutes. So in 2 candles on this 3-minute chart. That tells you that you were able to read the lower time frames accurately, and your strategy is actually something accurate. It's not something that you enter and it takes 35 minutes to hit your stop loss or to hit your take profit. Okay, most important thing is to have a similar framework every single day. Okay, now I'm gonna take a look at the questions that we have from let's say the explanation that I just did, and if not, I want to ask you guys, do you guys want to do the trade wars, so backtesting tournament, or do you guys want me to go a little bit deeper into how what needs to align in order for you to hold your trades for longer? I think that is also a really good thing to talk about, because I only talk about quick scalps here and there, but there is structure on the higher time frame that you can locate yourself inside a higher time frame candle that you would be really happy to know about. Because of course you may know those concepts, but the way that I will explain that to you, it will click. Because one thing I will say always is that since English is, let's say, my second language, then I always use terms. I try to dumb it out the best possible way so everyone can understand it. Okay, and also I use the market auction theory to make you guys understand the concepts of aggressive buying, aggressive selling. So you're like, okay, this is when I should enter, this is when I should stay out. So tell me guys, what do you want right now? One or two. So one being trade wars, but there will not be any giveaways related to the trade wars right now. Okay. But the giveaway is just on Botrick, so I'm just gonna ask you guys to type something in the chat, and then Botrix is gonna select the winner. Okay. From the backtesting war from last week, did the top three win? The top three did receive 25k lightning accounts, but right now we're waiting a little bit more to make those giveaways something permanent, basically, because for now there is way too many ways you could potentially breach and not trade the right way. Because let's say this is what I saw some amount of profits that were not possible, let's say, to do without let's say breaching in some sort of ways. So we rather fix few things before we give out those giveaways for no reason. Right. But I will definitely give away 2 accounts. How many likes do we have, guys, right now? We have 67. So at 100 likes, I will give away 2 50k growth accounts. And you guys know right now, with the changes that Tradeify made today, you guys can get paid a lot with those growth accounts. It's like the first payout is 1.5k, the second is 2, let's say on a 50k, the second is 2k, the third is 2.5, the fourth is 3k. It's the amount of money you could get paid on 150k, which is crazy. So at 100 likes, I will do both giveaways. So make sure to smash that thumbs up. All right. Right now I see we're 101. So come on, guys, lock that in. But yeah, so all right, let's go in and talk about let's talk about my view of the market and what I think is really good to have in your arsenal. Okay, in my opinion, the way that I trade, okay, I have a scalp strategy. I have a scalping strategy more based on one-to-one risk to reward. Okay, why do I like it? I told you guys, it's something that I can make money on. Consolidating market, trendy market, and since it's low risk to reward, my equity curve is gonna go up most of the times, and I'm not gonna have big swings in my equity curve, so my psychology will always be all right. And I'm comfortable with that strategy. All right, and I know that those confirmation that I'm using on, let's say, the 1 minute, 2 minute, or 3 minute chart are accurate, but not to predict big moves. Good. So now what do I have? Also, I know when to look for my A plus higher time frame setup. Okay, those kind of setups will not happen all the time. Okay, so you have a scalp strategy that generates cash flow. Okay, this is something you see pretty often. You have a low risk to reward, high win rate. Good. Every single day I can scalp 10 to 15 handles. I can sleep well at night, and this gives me money in my bank account. This is basically what I do. And then you would have an A plus setup where basically it only happens, let's say, 5 times in a month. Okay, and why is that? Is because for you to have an A plus setup, everything needs to align together for you to take a trade with high conviction and let it run towards bigger targets. Okay, higher time frame trades, or let's say high risk to reward trades, are not trades that you can find every single day with accuracy. Okay, so this is what I preach. So have a scalping strategy, low risk to reward, generates cash flow, low, and also a high risk to reward strategy that only happens 4 to 5 times a month that you can really rely on. So now let's talk about the second one, because I'm always talking about the first one. The second one is something that I don't see a lot of people talk about, but is extremely valuable. Okay, so first thing is we need to understand two concepts. Okay, basically one concept, and it's the power of three. Okay, what is the power of three? It's understanding. Let me just do this. So right now we're digging into, okay, how to find high risk toward trades rather than doing trade wars for now, but we're gonna do the giveaway, guys. Do not worry. At 115 likes, come on. Good job. Okay, we're gonna do the giveaway for sure at 250k gross accounts, but let me just go over the trades here that I judge being A plus and that are not happening every single day in the chart. Okay, so what's the power of three? The only way really to be able to day trade a high risk to reward is if you can understand the daily chart. Okay, what is the daily chart? It's the chart that will basically, in a day, you will see either a distribution or you will see accumulation. So if you can predict one candle on the daily chart, you can basically find a high risk to reward trade on the day. But it is really hard to find a good trade on the, basically it's really hard to find where a daily candle will go because a lot of things need to align together. Good. So here on this daily chart, we know that on those daily bullish candles, price usually opens, creates the low first. So this is the timing we're actually looking for. Creates the low first, pushes up above the opening price, holds the opening price, shoots up, creates the high, and then closes. Good. Now we understand that most of my daily candles look like those. It's called a open, low, high, close. Perfect. But now on the daily candle, there is multiple sessions happening. There's not just the New York session, which all the people are trading. There is Asia, there is London, and there is also New York. Okay, but one thing is this open right here starts usually on Asia. So if you want to predict a daily candle, okay, so if you're like, okay, this next daily candle will most likely close bullish, in my opinion, looking at the higher time frame chart, the only way to really validate that is to look at what did we do in the overnight session? What was my Asian range? What was my London range? And what am I doing at the open in New York so I can basically either play a reversal or play a continuation? Good. So here, the daily candle opens up at 6 p.m. every single day. And if you want to predict a bullish daily candle, usually Asia is an accumulation phase, okay? Open, it accumulates. Then the best trades are found, in my opinion, when London opens, sweeps the Asian range, so sweeps the Asian low, and market structure shifts above the Asian high. And once we open, so right here, this would be London, and when we open during New York, right here, let's say this would be New York session, we open during New York, you would look for those pullbacks right here to play the longs because we're above the opening price. And if London created the low, okay, usually a bullish candle will create the low of its candle first and then will create the high. So timing wise, you would want London to create the low of the day and open in New York above the opening price on the daily. So you look for those pullback plays to see those continuations. Good. Now there is way more than this to know about, because this is just one way to look at the chart. Okay, this is called basically this right here. If you're looking at this daily candle, there is usually three ways you can locate yourself using those Asia, London, and New York sessions. And this is right here, it's called, let's say here is NY. This is called, the first one is called the New York, so London reversal, NY continuation. Okay, so usually, let's say you're like, okay, damn, Amos, I don't know how to find my bias on a day when I open in New York. This was a question I was asked. This is the way that you can find your bias. You're looking at what London is doing, Asian is doing, and if London formed the low or the high of day and your market structure shifted, the sellers are so strong on the higher time frame that you looking at a potential reversal doesn't have a lot of chances of happening. Okay, so what do you want to do? This is the London reversal, New York continuation. We will be able to look at it later. I'm going to show you guys how to view it basically. Okay, so here, is there a way I can just, I'm just going to delete that. Okay, one by one. All right, so now, good. Now the second thing we're going to be looking for is when the best thing, the best trades always, in my opinion, are these ones right here, when there is a London reversal and New York continuation. But there's also one thing that is called seek and destroy. And seek and destroy conditions are what? It's when the Asian forms a range, okay, and then let's say it would be bigger, okay, let's say it forms a range, then London opens, sweeps the high and the low of Asian, okay, so now, and then it reaccumulates. So then I can draw this box again, and when New York opens, then it means that you're most likely on a daily candle that is basically an inside bar. It means that on the daily candle, you're not going anywhere, so you know you're accumulating. And if you know you're accumulating right now, it's a really good sign that you can play the reversals in the extremes. So when New York opens right here, this is, let's say, this is London, and this is Asia. When New York opens, then and price goes down first, you could play the extremes back towards the London highs, because you know on the daily you're on an inside bar candle. Okay, looking at this is all based on the power of 3. And then there's one more, of course, but you will see I will use an indicator, and you will be able to this is one thing I really like to do. You'll be able to see, okay, damn, where do you think price is going to go based on what I just explained right here? And now you will be able to understand a little bit more about how to position yourself in the New York Open. This is the indicator I'm going to use for this backtesting, and it's called ICT kill zones. Okay, and what we're going to do is that we're going to try to find those setups that I was talking to you guys about. Okay, when London creates the low, when Asia creates the, let's say, the high, or vice versa. Okay, there I showed you guys two ways, but there's like 4 or 5 to understand a daily candle. So just let's start right here together, and I want you guys to play with me and try to understand where price is most likely going to go. Okay, so we're always going to see, so the blue right here is Asia. Let me just get rid of those right here, but this is a nice game we can play. So we have the blue, which is Asia, the orange, which is London, and we have the green, which is New York AM session. Okay, so now our job is to try to find where price is most likely going to go on the higher time frame. I'm always saying this is way more important than understanding, okay, what's going on in the lower time frames, because if you know the direction overall of the market, you understood the market mechanics, so you could find trades with different entries and adapt to those market conditions. So as you guys see right here, what happened? Asian chopped, London pushed down here. So now my daily candle, how is it actually looking like? It's looking like a bearish candle. Okay, if I go on the daily, since we opened up right here, okay, it already formed its upwick and it's going down right here. So now once the New York opens, this is not necessarily one thing that I was talking to you guys about earlier. It's not the perfect scenario where everything is aligning together. We have resting liquidity from Asia, but there is multiple ways you can play that. And here I will stay patient. Where do you guys think price will go once New York opens? So it opened up right here, and we created this bearish 15-minute fair value gap. But you guys see London didn't sweep Asia high right here. So of course, it's a huge bearish day. So now it's hard to find the bias on this one. But let's say here in this case, you could have the bias of, all right, since Asia chopped, London pushed down, so the high of days is been made by Asia. The chances are we're displacing down so aggressively that this candle will not flip back bullish. This is where it all comes down to. It will not flip back bullish. So what can you do in this case? It's either you find shorts from this 15-minute gap back down, or you try to find lower time frame pullbacks to equilibrium. That's how we call them. So let's say here was London going down, and New York opens up, aggressively goes down. So then you know that price will most likely pull back to 50% of this range here to find sellers to then go back. So you could try to take a counter trend move, but this is not an A plus setup. This is what I want to show you guys. This is not an A plus setup. Not everything is aligning together right here for you to take a trade, okay? But let's say in this case, since we have Asian and London buy side liquidity not being swept yet, we could definitely try to take a counter trend trade and put our stop loss to break even pretty fast, knowing that it will retrace back into this 15, let's say, okay? And here you got the push up, put your stop loss back at break even, try to aim for that, just that counter trend play back to 50% of that range, boom, and you're out, okay? But usually, since you know that daily candle is bearish right now, then the play right here is to play the continuation, okay? But the it's not necessarily that good because you would have wanted that London to sweep the high, okay? But look at what's going to happen right here. I don't exactly remember what happened, but if you start seeing some signs of aggression from those sellers right here, when the daily candle is already bearish, then you could see that continuation happen. And you see we went down again, okay, from that 15. It took some time right here, hella chop, but you basically, this is a day. How am I seeing it? This is a day where if you don't know how to scalp, you're cooked, okay? It's hard to read. It's hard to find a high probability trade, okay? We will see the days where it will be really easy, and let's keep going together. Let's see here, Asia opens, it chops, good. We're always having this daily candle in mind. Right now, this daily candle just opened up and it shoots up first, okay? So it's bullish. Now, what is London gonna do? London is pushing up without sweeping the Asia low. It looks a little bit like this, okay? Now, what is New York gonna do when we open? So now, just looking at this, okay, I can see that we are so aggressive on the daily chart. We're way above the daily open, which is right here, and this candle is looking bullish. So what can I do? I could find a counter trend play back here for a quick scalp, but overall the market is bullish right now. I don't want to aim for those resting liquidities because it's so far, it's lower probability. It's not a day where I can basically find high risk to reward trades, okay? So here in this case, let's wait. And then right here, you're forming a bullish 15-minute gap, and you know buyers are located right here. So you could take a basically lower time frame counter trend play back here to find your quick scalp on the day, okay? Or basically what you can do is wait for price to enter aggressively inside the zone, locate your sellers, wait for them to get squeezed, and then you go along because that daily candle is bullish as a hell, okay? So let's see here, this 15-minute candle cannot close above the previous candle's high. What am I going to do? Scale down to those lower time frames to find signs of weakness right here. Then we shifted here in market structure. Now let's wait for extra confirmations. Let's wait for, let's say, an order block to get formed. This is, let's say, it's not necessarily that good, but Let's wait on the 5. Yeah, okay, that 5 is closing like this. So right here, let's say you go short on the 5, stop loss right above this candle's high, and you aim for a quick scalp knowing that it's a counter trend play, but buyers are located right here. And for us to create an up move from this leg, we would need fuel. We're exhausted here with the amount of candles that printed here. We need some fuel. What is my fuel? Unfilled 15-minute gaps. These are where my buyers are located on the higher time frame. So let's say you short here, stop loss right above this candle's high. Let's see what price is going to do. Goes back down and fills your gap. Okay, so right here, this is where you get out, and look at what price is most likely going to do. Possibly react to this 15 and go up again. Okay, right here. So this day, again, in my opinion, is not a day worth trading a high risk to reward setup. Let's wait again and see a day that, okay, damn, this is just perfect, and we have all the confirmation that tells us that this is the real high of the day, or this is the real low of the day. Okay, oh shit, I'm on the 5, I'm so sorry. Well, these sessions are nice. Like this way here, it's really nice because you're trying to understand the market, how the market is actually moving. You're not trying to be like, okay, S&T at the highs, break of structure, I'm in 2 contracts, stop loss above the high, and I should print this amount of money. No, it doesn't work like that. You guys already know. So let's say here, what is happening, it's basically what I showed you guys, the second model that I showed you guys. It's the seek and destroy for now. So we created an Asian range. London swept the high and swept the low. So now what is going to happen in New York session? Exactly this. Boom. Perfect. So now we know we are in seek and destroy. I think it's called exactly this way. Everyone is calling like how is it called? Search and destroy because of COD, but it's called seek and destroy market condition. What does that mean? It means that right now on the daily chart, okay, it's like an inside bar candle. It's a pin bar, not a pin bar, but it's like a how do we call it? Those hammers, like a candle that goes nowhere. Okay, so it's an accumulation candle on the daily. Why? The daily opened up right here. Okay, and we formed a range during Asia and London, and we traded nowhere from there. What do I know? I know that price is in really good conditions for me to take a trade, a high risk to reward trade, because I can locate basically the type of day that I am in. So here I will mark out those London lows, and I will wait. I know that I could play the extremes because we're in a consolidation market. So now if I sweep the London low and shift, this is a really good scalp back up for 1 to 2, 1 to 3, 1 to 4. Okay, so yeah, it's a doji candle on the higher time frame. So let's see here, you see Asia is here, London is here. It's exactly the same shit I showed you guys. Okay, so here let's wait. New York is gonna open in literally 30 seconds. Okay, so now shoots down. What is this move down first? It's called the Judah swing. So the 930 move usually is not the real move. It's a move that goes to hunt liquidity, and then price should go back in the opposite direction, because this move is just basically to have enough fuel for the real move to happen on the chart. So now sweeps this low. And what is going to happen? I want to find signs that I can go back long for 1 to 2, 1 to 3, because I know that I was able to basically dictate what daily candle we were in. So here, let's wait. So now I would wait a little bit more. I would wait for at least an order block or an inversion for value gap. Here you get both. You sweep the London low and you get, look at what you get. Okay, you get an inverse, you get an order block, you get everything that you ever wanted here. And you know that price has a lot of chances of going back towards the opposing liquidity, or at least for a 1 to 2, 1 to 3, because you were able to know what daily candle we were actually trading in right now. Okay, so here, gotta go long here, I'm sorry, but usually what you can do is wait for price to pull back towards structure and then aim for higher time, basically higher risk to reward trades. Okay, and you have a really good target that you can locate right here. So now waiting for price to push up, pushed up, nice, and then goes up again. So now you almost already secured your 1 to 2. This is a trade that I was able to dictate a 1 to 2 because it was really accurate. I knew what I was doing. But in most days, it's super hard. It's not everything is aligning exactly like this for you to be able to know that price is going to go towards the opposite liquidity. Right now, this is, let's say, a moment here that I would trim and put my stop loss most likely to break even. Okay. And then let's wait. Let's see what price is going to do. Pulls back. And right here, you got stopped out to break even on the rest of your position, but you secured some good profits right here. One thing you need to know, and you need to basically be super cautious of, are SMTs. Okay, SMTs is when NQ, basically ES, sweeps this high, which was your target. That means that NQ doesn't need necessarily to sweep this high because it grabbed the liquidity from ES. And since ES and NQ are correlated pairs, then you always need to be trading those two in correlation. Okay, they should be doing the same exact thing all the time. Okay, so there's a lot of ways to look at the market. There's a lot of there's a lot of ways to catch plays, but in my opinion, if you want to catch a high risk toward play, a lot of things need to align together in order for you to be confident in holding your trades. In my opinion, it's not because of what happened here on the 1 minute chart that price will go back towards 1 to 2 or 1 to 3. No, it's because of what the daily candle is doing. You are well aligned with the higher time frame, and we know that the higher time frame is what rules this market. Now let's just do one more try, and we're gonna try to find it because we're already out of time. Oh damn, I don't know how to do the giveaway on this. I don't have access to the bot rigs. Shit. I'm just gonna select 2 random people. I'm definitely just gonna select 2 random people. Or ask me, what can we do for the giveaway? Because it can't be like a random giveaway. I would need like to choose it in a sense. So like either you make me laugh or like something like that. All right, so here you guys see, okay, we are forming the Asia session right here, and the London pushes up and also forms a range. So now I have a scenario where I'm inside Asia's low and London's high. So now basically what's going to happen is that I know, basically this is another concept, it's if there is resting liquidity close to me once we open at 9:30, I could expect that liquidity to get taken out. Okay, so here, how would you position yourself at the open? You know you should be a buyer because you're closer to London high, and right now on the daily, we are bullish, trading above the opening price. So you don't want to fade that bullish daily candle. I hate people saying, okay, wait for the open high, flip. Bro, you're most likely never going to catch a full-on daily reversal. Impossible. Or even that, you would need to trade you would need to trade Asia and London session to catch those. Okay, let's do, all right, on God, I'm not gonna cheat. Let's do a random number. You cannot spam. Okay, let's do a random number from 1 to 200. You have 1 try. Go. And I already have my numbers. All right, but here in this case, okay, I'm gonna look at it. No, okay, Tevin, you got 1. Tevin J, okay, 199. Okay, the first one goes to Tevin J. Okay, lock in. 1 to 200. Tevin J, you won the first. No. Guys, lock in. It's easy. It's easy. It's an easy number. 200. Let's go. Scratch Hand Smith. So Tevin J and Scratch Hand Smith. Sorry, I looked absolutely dumb saying that, but these are the guys that that won. Unfortunately, it was 199 and 200. I said that on the fly, so you guys had to guess that it was gonna be easy numbers. Come on, guys. But let's do this last one. No, let's do two more. Okay, let's see here. What would I expect? I would expect New York to open on the Judas swing to sweep out London High. Okay, I don't even know the exactly. You see here, I didn't even know. I swear to God, I didn't even see that happening. I don't remember what happened on the 6th, but here we're close to London High, so I expect that if we sweep some sort of liquidity, then shift, I could go back towards the London High. So there, if I go down to those lower time frames, I want to position myself as being a buyer at the open. But here it was really hard, let's say with this, but buying here in any sort of pullbacks or below lows would have been a good trade back up, right here. You see, back to the upside towards the London High. And right here, why is it hard to know if it's going to reverse? Because you don't have everything aligning together on the daily telling you, all right, it's a reversal. You see, it went up. We didn't know what was going to happen here. So let's just wait for a perfect scenario, which is a London high and New York, London reversal and New York continuation. Let's wait for it. Right here, it's a trade where you could play the counter trend. Right here, in this case, you see this 15-minute bar closes back inside the range. You have London and Asian resting liquidity, not necessarily a play that you would try to push price down all the way to those lows, because the daily candle is really aggressive to the upside. But right here, you still have shorts back down for, let's say, 1-to-1. Here you hit the target, but of course it's not going to reverse as easily on the daily chart, and these are the statistics you need to understand. Okay, good. Right here, opened up. Nah, this is S. This was again a hard trade to take. Also, consolidation. Let's wait for a really good setup to show up. All right, that's really these are hard still. I would still say that we have a lot of chances of going towards the Asia high and London high. You see right here what happened. 930 opened lower, couldn't sweep the Asian low, pushed up to the upside. We have London and Asian resting liquidity above. So let's just wait for the scenario I was talking to you guys about. Yeah, these scenarios are not happening right now. Fortunately, you see, like, it doesn't happen often. Okay, like having everything aligning together, it doesn't happen often. Again, Asian formed the low of day, so right here, hard. So it was a reversal day. It doesn't happen quite often. Let's do this one more. All right, buddy. Let's wait. Let's wait for an A plus setup, and I know, okay, damn. Okay, right here, we are on the seek and destroy conditions. So right now, as you guys can see, I just swept. So since that's hard. I didn't shift before. That is a really hard trade to take, because that could be a continuation. Yeah, that is a really hard trade to take. But right here, since basically what you would tell yourself, it's not the best, but here's what you could tell yourself is that, okay, Asian ranged, London opened higher, and then right now we're shifting below Asian low. So on the higher time frame where market structure shifting and the daily candle is absolutely bearish below the open. So now the chances are we're not going to reverse fully on that daily just because it's New York open. We will most likely see a continuation move back down. So here in this case, you would use this 15-minute gap as being your real market structure shift and aim for daily lows, or this New York AM session low. So let's say here in this case, a trade that looks like this, market structure shift on the lower time frames, tight stop loss, aiming for 1 to 3s, 1 to 4s would make sense. Let's see what price is going to do. And here, make sure you look at SMTs also with ES. If ES swept this New York AM low, make sure to get out, let's say. And here you guys see this was a good play. Okay, it was not necessarily as easy to see, but it was a New York continuation. Okay, because we shifted below Asia low and London was the real high of day, and we formed a 15-minute gap. If you are shifting from that 15-minute gap, it is a really good confirmation to go short from. So hopefully you guys enjoyed this session. I really enjoyed doing that because it's not necessarily about understanding a lower time frame strategy and understanding the rules you need to apply. It's really about having a framework that you can rely on and that you know you can dictate where price is going to go on the higher time frame. It's all about this. It's all about a framework that is repeatable on the higher time frame that can let you read it in an accurate way. Okay, so hopefully you guys enjoyed this session. I really enjoyed that, and of course it was something new for some of you guys that are not using ICT concepts. But one thing also to note about this is not every single day is a high probability day, and it's not every day that you will have perfect trades to aim for 1 to 3s, 1 to 4s. Okay, have 4 to 6, 7 days. Okay, don't meme it, but 7 days I would say to aim for those high RR plays, and the days where everything is aligning together to have confidence in those plays. But for the rest, quick scalps are usually what works really well in all market conditions. You could trade this during London for sure, but you would need to, when you trade during London, let's say you try to catch the real high of day, these are higher risk to reward plays. Let's say here, like your overall bias is that you're telling yourself, all right, I predict that the next candle on the daily chart is bearish. Okay, it's always about predicting when it's a higher risk to reward. Okay, so let's say the Asian opens and it's consolidating, and then London opens up, sweeps the Asian high, and then shifts right here. So now you know that a bearish candle creates a open high, flips below the open, creates the low, and then closes. This is the timing of a daily candle, how it should basically be formed. So now you know that if you went higher, you're possibly forming the upwick of a bearish daily candle. So now you would try to take the shorts here and let it ride all the way down to New York, and then in New York you would have that continuation move back down. Okay, but these are plays where you're trying to catch the top and the bottom of the daily, and it's really hard. It goes way deeper than just understanding the mechanics of the daily candle. It goes into standard deviation projections and really understanding the daily chart to a whole other level. Okay, and those are stuff where the market is not necessarily going to act the same way all the time. So I appreciate you guys so much, and make sure to look at the new changes that Tradeify made. These are absolutely amazing in my opinion. And also there is a game night, I think, pretty soon, so make sure to tune in that game night also. Appreciate you guys so much, and I see you guys in the next backtesting session. It was hella fun, and next time we'll do the tournament for sure. All right, peace out guys, much love, see you guys on